What is going on, everyone? Welcome back to another video. This is going to be a really exciting topic. I have done a video on this topic previously, but I feel like I need to address it again since the way I trade and when I put out my posts on social media and my content, I see this question on repeat. I see people accusing indicators of being bad. Indicators are lagging, price action is king. And while I believe every trader needs to have a solid foundation on price action and how it moves, I'm going to be talking about in this video why I believe indicators are superior if you are a struggling trader or if you need a more defined way in your trading to remove the subjectivity like I did, what took me from struggling to profitable. Now, I'm going to show you the methods I used to use. I used them for about 1.5 years with my back testing in the system with my previous trading education company I was with. Ever since I found ASFX and Austin taught me about the exponential moving averages and another indicator I will talk at the end of the video called the TDI indicator, the Traders Dynamic Index. It really has shifted my perspective on the financial markets and reading a price chart. Hopefully a quick video and show you guys price action versus indicators and show you how they kind of mash together, if they are lagging and what it means when an indicator is lagging and why it's not so much of an issue with us day traders. You got to remember, I would rather the extra confluence and confirmation and confidence in my trading than getting in at the best price and then freaking out. And that's a whole nother topic for another video. So let's jump into the charts and get in with this. And before we do that, if you're new to the channel, my name is Jerome. I'm a full-time Forex trader here in Sydney, Australia. If you've seen any of my videos, please, if you get value from them, smash the thumbs up button. Don't forget to subscribe to the channel and hit that bell icon so you get notified for any future content I put out. So let's jump into the chart real quickly. So what you are seeing here is essentially the 15-minute chart. I am purposely using the lower time frames because there is a lot of noise. And that is one thing you see a lot of traders say. The lower time frames have too much noise, too much false breakouts. With indicators, you can essentially remove that noise and get a bigger picture, clearer picture of what's happening inside the market. So let me get rid of this indicator at the bottom. And what you are looking at now is GBP JPY naked chart. No indicators, just pure price action. The most important thing as a trader, I believe every trader needs to know, is how to identify what state the market is in. Is it trending? Is it consolidating? Simply, if the price is up here and it's going from the top left to the bottom right of your screen, you are in a downtrend. Do not overcomplicate it. If price is going from the bottom left of your screen and going up to the top right, you are in an uptrend. Simple as that. If price is doing this, straight across, you are in consolidation. I'm not going to go into the rules too much about this as I want to show you how I used to read trends and how I define trends in the market using pure price action. So, and then we're going to overlap exponential moving averages on there. EMAs essentially gather data from price. Let's say you're using the 50 period exponential moving average on the daily time frame. It is essentially taking 50 days worth of trading action, smoothing it out, and it also provides as support, dynamic support and resistance. I'll go more into that in a minute. How I used to define my trends using price action. Let's just start up here. And I would simply draw the ebbs and flows using lower highs and lower low, break below or close above. What that means is you can see price comes down here and then we get that pullback. And then price comes down here. So this is what confirms a trend and what my previous education called a 3-point move. And it essentially tells you that the market is now trending. Basically, you would just keep drawing this until the trend was violated. So let's keep going. Pullback, extension, pullback, extension, pullback, extension. And then we got the pullback, which violated this outside return right there, which means the trend could reverse. And what happens is using just general support and resistance, you get that pullback. And then using this previous outside return, you get, I can use this one and I'll explain to you why I don't like this method. Before I do explain to you why I don't like it, there is absolutely nothing wrong with this method. It is a great method to read the ebbs and flows and read trends in the market. There are some traders like myself who have a very hard time building rules around this, and it induces a lot of subjectivity. When I backtested for almost a year using this exact same strategy to define my trends and a system incorporating it, the returns and the trading performance was perfect. It was a great system. I had a 60+% win rate, and the returns were, the risk to reward and the trades were great. When it came to trading it live, this is where things got a little bit hairy, because I couldn't execute the trades. I questioned myself. I didn't have the confidence to pull the trigger, and there was a lot of subjectivity into what I was doing. I went back, I tried to define rules, and I just simply couldn't do it. Until I came across Austin Silver, and this is exactly what I'm about to show you right now. What you are looking at is the exact same ebbs and flows I just drawn using price action. And also, before we go further, I salute you guys that trade pure price action. It is it's something I have always tried to do, but once again, there is no right or wrong way to do this. And once you understand that as a trader, using indicators is okay. And why I say that is because check this out. If I turn on these indicators right here, exponential moving averages, what the story tells us of what's happening right now is the yellow line is the 8 moving average, the red is the 21, and the blue is the 50 exponential moving average. The 50 exponential moving average is the bias. If it breaks above, my bias may change from a bear bias to a bullish bias. So from a short trend to a long trend. The 50 exponential moving average is the bias. If we are in an uptrend and price comes back down, breaks below the 50 exponential moving average, that may change my directional bias, and then vice versa. If we're in a downtrend, price comes back up, breaks above the 50 exponential moving average, that may change my bias into a long trend from a bearish trend. So looking at this chart, what you can simply see now is price was trending up. We took this, so right here, you can see price holds the 50 EMA. Price comes up, you get that 8 and 21 upshift. This is the short-term trend. What is price doing in the short term? So you can see we are trending upwards. Price pulls back. What does it do? It rejects the 50 exponential moving average. That is the bias. Like I said, if it breaks below, it may change my bias. So you can see we got that kind of rejection candle off the 50. And what happens next? Price rallies straight up, creating a new high. And now, as you can see, price pull back here. You may still think to yourself, are we in a bullish trend? Well, this is what I love about the indicators, is that you can create solid rules around what's happening and reacting to a chart, not predicting. What happens is, like I said, price breaks the 50 exponential moving average with this candle right here. Now my bias has shifted from an uptrend to a downtrend, and note the 8 and 21 moving averages go into a short-term downtrend. So now I am bearish on this chart. So looking at this and then seeing what happens, we get that new low, which takes out this previous resistance over here. Let me just draw that in there. And then I'm going to draw this from this low over here as well. And remember before when I said bottom left to top right uptrend, and then top left, bottom right downtrend, I then mentioned sideways movement. So simply you could block out this whole little area right here and be like, hey, price is consolidating until what? Until it breaks below this point right here. So until price breaks below here, then I would be more inclined to be bearish and confirmed bear trend instead of price coming back up. So let me just get rid of these boxes real quickly and explain exactly how I see the charts and how this has really helped me. While price is kind of chopping and the EMAs are together, I am simply not looking for entries. I'm waiting for a break above or a close above and the EMAs to be in trend. And you can see that directly in here, where you get that short-term downtrend as well. So just clicking on the indicators right there, you can see the 8 falls below the 21, the 50 is on top, and then looking at price action, you can see that the price can't get above the EMAs. So we got that break above the 50, price consolidates, comes up, and then comes back down, and it can't hold above it. Price comes back down, comes back up to the 50 exponential moving average, we get an indecision candle, price breaks back below it and can't hold above. Same thing, indecision candle around the 50 exponential moving average, all while the short-term trend is staying intact. So the 8 and 21 EMAs aren't upshifting, which means the 8 crosses above the 21. This tells me that we are still in a short-term downtrend. We get this push off the 50 and price just melts away. Using that knowledge as well, you can see price now holds the short-term trend, 8 and 21, comes up to the 21, and then keeps falling. Comes up to the 21 over here, and then keeps falling. Comes up to the 21. And you remember I said with the price action how it broke this zone, and that would confirm using just price action, it would confirm that the trend is now reversing. You can now see that with the EMAs. Like I said, if price breaks the 50 exponential moving average, if we're in a bearish trend and it breaks it back above on the pullback, that is what's going to change my directional bias. You can see we had the same thing happen here. Price breaks above, comes back down, and then comes back above it. And then you can see the trend reverse. Price rejects the 50 exponential moving average with a big bar, continues up, 8 and 21, still in the upshift. I'm now long bias on this until it kind of breaks below here. In this example over here, you would simply just wait. It broke above, you would wait for extra confirmation to tell you that the trend may be reversing. Price can't hold below the 50 exponential moving average, comes back up, holds the 50, upshift, 8 and 21 upshift, short-term long trend is back in play. And you can see that on repeat over and over again. This is how I use exponential moving averages to define what I am looking at and create rules around that, to tell me what market conditions I'm in and if we are trending, if we're not. I can get involved on really, really good trending moves, and then I can use the EMAs to find entries as well on the lower time frame, exactly how we are taught at ASFX. So now let me introduce the TDI indicator, the Traders Dynamic Index. This thing is an amazing indicator. Once again, it's no holy grail. It's just a good indication of what's happening in the market, and it's giving you more detail, removing the noise and telling you the bigger story of what's happening. So if I just double click again, now you guys can see the TDI indicator. And the main thing I want you guys to look at is the yellow line. This is the L50, as we call it, the market sentiment. Now, you can see real briefly on the TDI indicator, the 50 value is in the middle. If price, the L50 is above the 50 value, I am bullish. If it is below the 50 value, I am bearish. So keep that in mind. As price breaks above the 50 moving average over here, see how price breaks with this bar? You can see the L50 down here pull into the buy zone above the 50 value. As price ebbs and flows, it trends holding the 50. It is still in the buy zone, giving me my long bias. Using the EMAs and the TDI indicator together is a very powerful combination, and it can give you some really accurate signals in the market. Coming over to the TDI indicator, so looking at the bottom here, you can now see the L50 yellow line pulls into the sell zone below the 50 value, and what happens while that's consolidating. So while the market's price is just consolidating, just ranging right here, you can use the TDI indicator to confirm what may happen next. Not that we like predicting what's happening next, we are reacting. If this pulled back into the buy zone, I may have said, hey, this may come higher, but because it held the sell zone below the 50 value, you can see it never swapped above, I am now still bearish. And as you can see, price fell. Keeps falling until what happens next. You can see in this example right here, L50 yellow line pulls above the 50 value into the buy zone, as well as a break of the 50 exponential moving average. Combining those two indicators together tells me, hey, we may now see a shift into a short-term long trend, short-term bullish trend. Same thing before, as price is ranging, keeps breaking the 50 exponential moving average, or the EMAs are like kind of together and mushy. You don't know what's happening in the market. You can then look at the TDI and say, hey, it is holding the buy zone. I'm going to be bullish until it says otherwise. Systematic rules-based rules. And what happens? It holds the buy zone and builds the momentum and keeps going higher. Same thing over here, as I said. See how it breaks the 50 exponential moving average? You don't just confirm your long bias is over just yet. Using the second indicator on the TDI, you can be like, hey, the L50 is still holding above the 50 value. I'm still looking for longs. Price continues higher. Same thing over here. Price comes down to the 50. You can see it. Just retest it. Short-term trend, EMAs, all looking kind of close together. As it comes together, it just pins the 50. L50 is still in the buy zone, continues higher. Now, before I go any further, you can see right here, L50 drops into the sell zone below the 50 value. You can see over here, price breaks the 50 exponential moving average with a strong bar. Price is kind of holding it. What happens next is a lot of choppiness and a lot of kind of price just moving everywhere. On the chart, this is around Christmas, 25th of December, 2021. Of course, this is expected. It's not a very good day to be trading on, and you shouldn't. No liquidity, no volume. So that explains all the big wicks and the choppiness and ranging of the market. After the Christmas period is finished, you can see that the trend kind of picks up. You got the 821 trend, and you got that big push. What happens next? The L50 is now in the buy zone, shifts from the sell zone above to the buy zone. And the big question is, how do you signal out all these false signals? Well, the easy answer to that, it was Christmas, but using the exponential moving average and short-term trend. So we also have other indicators as well, such as the 1 minute and divergence that can really help with these setups and to identify the direction of the trade. So you can see here, L50 pulls into the buy zone, rejects the 58 EMA, this candle, that candle pulls up, rejection, rejection, candle off it, and then L50 in the buy zone continues up. That is essentially why I love using the indicators. It's not magic, it's just simply gathering data from price, smoothing it out, eliminating the noise, giving you dynamic support and resistance and levels to trade off, and it goes so much deeper into that as well. It tells you the bigger story, and it is something that you can really create clear, defined rules around. Did it break the 50? Great, done. Is the L50 in the sell zone or buy zone? Yes, ticket, done. You are not looking for certain things in the market that create a lot of subjectivity. Trading price action itself is an art and a science, and it takes a lot of experience and chart time to really train your eyes, especially in the beginning, to start seeing those patterns on repeat and just becoming completely your subconscious just picking them up without any effort. With the indicators, however, if you are a struggling trader or new trader, this is the way. Once again, you should have a great foundation of how to read naked price action, know how to identify the trends, know how to, support and resistance, all that stuff that kind of defines the financial market and price action. The indicators are just there to help you navigate it. That is it. You are finding entries off these levels because exponential moving averages, EMAs, they are basically levels in the market that can be traded off, which is another really cool thing. You can define your entries and exits and trade management with these moving averages and the TDI as well. As long as you are consistent and can be consistent with a method, that is all that matters. If you're consistent trading naked charts, pure price action, continue to do so. If you struggle and need to, get the bigger story, remove some of the noise, smooth out price, then using the indicators is the better option. Once again, there is no better way. It's only the better way that suits you and your personality. So I hope you guys got some value out of this video. If you did, please smash the like button. Don't forget to subscribe to my channel, and don't forget to hit that bell icon to get notified for any future content I put out. As well, drop a comment below. Let me know your thoughts about this video. I like talking about the indicators versus price action with traders. I am open-minded. There's no need to argue with me. I'm not going to argue back with you, but let me know your thoughts below. I'm really curious to understand your perspective of the market. I hope you guys enjoyed the video. Until then, stay safe, and I'll see you in the next one.